Most investors build dividend portfolios like they are packing for a vacation with no destination. 3 shirts, 6 chargers, and somehow no socks. Today, I'm going to show you how 4 dividend ETFs can work together as a cleaner U.S. dividend sleeve, so your portfolio is not just chasing yield, but building income, quality, growth, and flexibility. If you are trying to build wealth, retire with confidence, or simply stop staring at your brokerage account like it owes you an apology, this matters. Dividend investing is not just about getting paid. It is about getting paid by companies strong enough to keep showing up when the market acts like it drank 3 energy drinks and forgot its job. Quick note, for a deeper dive related to wealth generation, get my book, The Wealth Basics, a practical guide to investing and building generational wealth, the stuff we should have learned in high school. Available on Amazon. Link is in the description. Now let's get started. Here's the plan. First, I'll explain what each ETF is designed to do. Then, I'll show you how they are different. Finally, I'll show you a simple way to think about combining them into a dividend sleeve without turning your portfolio into a financial junk drawer. So be sure to stick around until the end. Disclaimer: this content is for educational and entertainment purposes only, and is not financial, legal, or tax advice. Investing involves risk, including loss of principal. Consider your goals, time horizon, and risk tolerance before investing. Speak with a certified financial advisor to help you develop a customized plan. Now let's get back to learning. Think of this dividend sleeve like a 4-person basketball lineup. SCHD is the power forward, higher yield, quality screens, and a low 0.06% expense ratio. Schwab says SCHD tracks the Dow Jones U.S. Dividend 100 Index and had a 30-day SEC yield of 3.33% as of July 2026. DGRO is the balanced guard, broad dividend growth exposure, about 390 holdings, a 0.08% expense ratio, and a 30-day SEC yield of 1.98%, according to iShares. VIG is the calm veteran. Vanguard lists a 0.04% expense ratio and a 1.52% 30-day SEC yield, with a focus on companies that have grown dividends year over year. CGDV is the active manager in the group. Capital Group lists a 0.33% expense ratio, a 1.27% 30-day SEC yield, and a goal of income above the average yield of U.S. stocks with growth potential. But here's where most people get this wrong. They look at the highest yield and crown it king. That is like choosing a gym based only on the smoothie bar. Nice perk, but not the whole plan. SCHD is built for investors who want more current income with a quality filter. It screens for dividend sustainability and fundamental strength. Translation: it is trying to avoid companies whose dividends look juicy because the stock price fell through the floor like a cartoon piano. As of July 2026, the Chaikin Analytics rating for SCHD is bullish. DGRO is less about maximum yield today and more about dividend growth across a wider basket. iShares describes it as tracking U.S. stocks with a history of growing dividends. With nearly 4 times as many holdings as SCHD, DGRO can help reduce single fund concentration and bring in more growth-oriented dividend payers. As of July 2026, the Chaikin Analytics rating for DGRO is bullish. VIG is the consistency machine. Vanguard says it tracks the S&P U.S. Dividend Growers Index and emphasizes companies with a record of growing dividends year over year. The yield is lower, but the strategy is built around durability. VIG is not screaming for attention. It is quietly doing push-ups in the corner. As of July 2026, the Chaikin Analytics rating for VIG is neutral. CGDV is different because it is actively managed. Capital Group says the fund seeks income that exceeds the average yield of the S&P 500 while also providing growth of principal. That means a manager is making judgment calls instead of simply following an index. That can help, but it also means manager decisions can lag. Active management is like hiring a chef instead of using a recipe. Sometimes you get greatness, sometimes you get cilantro where nobody asked for cilantro. As of July 2026, the Chaikin Analytics rating for CGDV is bullish. Now, here's the part nobody talks about. These funds overlap in purpose, but not perfectly in personality. If you own all four blindly, you might feel diversified while secretly owning the same party with 4 different invitations. The fix is to assign each fund a job. Use SCHD as the income and quality anchor, use DGRO for broad dividend growth, use VIG for consistency and lower cost dividend discipline, use CGDV as the active satellite if you want professional selection and are comfortable paying more for it. A simple example could be 35% SCHD, 25% DGRO, 25% VIG, and 15% CGDV. That is not a recommendation. It is a framework. Vanguard emphasizes keeping costs low because low expenses reduce tracking drag, and Schwab highlights SCHD as a low-cost fund focused on dividend quality and sustainability. The real win is not finding the one perfect dividend ETF. The real win is building a sleeve where each fund has a reason to exist. So here's what you learned. SCHD brings higher yield and quality screens. DGRO brings broad dividend growth. VIG brings long-term dividend consistency at a rock-bottom cost. CGDV brings active management and a dividend value approach. Together, they can create a dividend sleeve that is more balanced than chasing yield alone. If you find this video helpful, make sure to like, share, subscribe, and hit the notification bell to help the channel grow and reach more investors who want to build smarter, calmer portfolios. Do you want a deeper dive into how to use AI to generate wealth? Grab your copy of AI Meets Finance, Investing in the Age of Artificial Intelligence, available on Amazon. Link is in the description. Continue your investment learning journey by watching the next video displayed on screen, and I'll see you in the next one.